Now that we've talked about revenue recognition and accounts receivable, let's talk a little bit about some of the other expenses and also about discontinued operations. And it's important to understand how numbers are calculated in order to understand how to use those figures when we're doing financial statement analysis. So these are some typical expense categories that we have. Cost of goods sold is the cost of making products or the cost of buying products that were sold. They only include the cost of products that were actually sold. So if we purchase inventory that we didn't sell, that would not be considered to be cost of goods sold. Selling informational and administrative expenses, the way I usually see this explained is selling general and administrative. I don't know why it says in informational there. And this would include, this is typically called overhead. So these are sales commissions, paying sales employees, your executive workforce, marketing costs, and all these kinds of things are usually lumped into SG&A. Research and development is the cost of researching and developing new products. Research and development costs in general are always expensed when they're incurred. So people argue that R&D is necessary, is really a cost of goods sold, and it should be capitalized. But we'll talk about this a little further. R&D, or research and development, is always expensed. Amortization of intangible assets is amortization of things like patents and trademarks. Restructuring costs, occasionally companies decide that certain assets just needs to come off the books. Or if they're going to do something called a restructuring, then there are specific costs that go along with doing a restructuring. So the company may decide it's going to do massive layoffs. If so, the accounting is that it needs to determine how much the layoffs are going to cost now and record an expense for now, even if they might not pay for all of those costs until a year or two from now. So they would estimate how much money they need to pay to lay off all these employees and record that expense immediately. Provision for income tax is like income tax expense, and oftentimes the students confuse this because it doesn't have the word expense in it. But provision for income taxes, or provision for taxes on income, is in fact income tax expense. And this includes not only federal income taxes, but also state and local income taxes. Discontinued operations occur when a company decides to close down or sell a business within itself. So this needs to be a distinct business, not just to sell certain assets like a building, but to take an entire line of business that the company has and sell it or close it down. What the company would need to do is it would need to estimate the total gain or loss from that decision that it's making and record the gain or loss as soon as it makes the decision. So if you decide to sell a business and you're going to have a loss, you're going to need to write it off next year. You actually need to record the loss, which is in essence a write-off, immediately. Non-controlling interest is kind of difficult to explain. And the way I would explain it is this, is that companies often have many subsidiaries. So let's say that a parent company owns a subsidiary company. But, this is the big but, it doesn't own 100% of the company, it only owns 80% of the company. So a parent company owns 80% of a subsidiary. That means that 20% of the subsidiary belongs to someone else. That someone else is called the non-controlling interest. So these are stockholders in the subsidiary. They own 20% of the subsidiary, but the parent company, whose financial statements you're looking at, owns 80%. So the parent company can pretty much do whatever it wants with a subsidiary, with one proviso. 20% of that subsidiary belongs to the non-controlling interest. So whatever profits the subsidiary has, 20% of those profits really belong to the non-controlling interest. If the subsidiary pays dividends, the parent is only entitled to 80% of the dividends because the parent only owns 80% of the stock. And the non-controlling interest is entitled to the other 20% of the dividends. So this is an important item, and what you'll typically see at the bottom of an income statement is you'll see consolidated net income minus income attributable to non-controlling interest equals income attributable to parent. And it's important to understand what these numbers mean. Let's talk a little more about research and development for a moment. Research and development consists of all of the costs of conducting research and developing new products. And these are the costs up until the point where the product is considered to be a viable product that's going to work in general. So once you have created a product and you know that you're pretty sure this is going to be a viable product, it works and it's saleable, then any remaining costs would be selling general administrative costs, or they may go other places in the balance sheet, or in the income statement rather. But R&D may consist of salaries and benefits for research and developers, supplies, licensing fees, payments to collaborators, laboratory, property, and buildings. These costs are all expensed immediately, all of them, unless it's for a general purpose PP&E that can be used for something else. So if the company builds a building an office building where it houses its R&D department, that office building is legitimate PP&E and it can be capitalized. But most other costs of research and development are going to be expensed. This doesn't make much sense because when you think about it, R&D is the cost of developing new products and it's going to bring in future revenue. So when a company develops a new product, that's eventually going to result in sales. So a good argument could be made that research and development is really an asset. And research shows that R&D, investors oftentimes treat R&D like an asset. Nonetheless, accountants require that it be expensed on the income statement. So what you want to do is you want to look at R&D expense very closely and compare a company's R&D to its peers. And you want to compare it as a percentage of revenues, and you also want to compare it as a whole number. And you want to try to predict what's going to happen in the future. How much does the company plan to continue to spend on R&D? Many companies, especially tech companies, need to spend a lot of money on their R&D in order to be successful because that's where the new products are going to come from. And if a company cuts back on its R&D, that may be a sign that it's trying to cut corners, and that could ultimately have a negative impact on sales. Discontinued operations is another strange item, and it goes to the way bottom of the income statement. And for us, it's particularly important because we have to know to ignore it. Discontinued operations would be recorded at a time when a company decides to sell or close down a segment of their business. And again, by segment, I mean a full segment that sells products, that has expenses, and things like that. Discontinued operations would not be where you close down a product that's related to other products, or you give up on a certain customer, or you decide to move your workers around and you close one office and have them work in another office. It would be where you close down a full segment of your business, and a segment of your business means it's a distinct part of the business that has its own revenues and has its own expenses. So when you discontinue an operation, what you need to do is you need to take everything related to that discontinued operations and move it over to discontinued operations. You're even going to estimate if there's going to be a future loss when you close it, and you'll include that in there too. You'll estimate that loss. So you would include all of the income from the operations, from that segment that you're discontinuing, up until the date that you decided to do the discontinuance, and anything forward going on. In essence, what we want to do is once we determine that a segment is going to be discontinued, we don't want to see it anymore in the income statement, because the income statement we're concerned about what's going to happen in the future. And discontinued operations is gone. It doesn't affect the future at all because it's been closed. So we're going to keep it completely separate, and we're not going to treat it like other portions of income. As it says here, it's transitory. It's not permanent in the sense that it's not going to help you to predict your future performance. So investors really don't want to look at discontinued operations because it's not going to affect your future performance. You specifically want to ignore it.